All right, let's jump right in. Today we're taking a look at the latest earnings from Worthington Enterprises. That's ticker WOR. And this quarter was, well, it was a real head-scratcher. You've got this great solid beat on revenue, but then a pretty noticeable miss on the bottom line. So what gives? And the market's reaction? Oh, that tells a story all by itself. Let's unpack this thing.
So, boom, right out of the gate. Here's the central problem. On the left, you've got revenue coming in hot, beating what the analysts expected by more than 5%. That's great. But on the right, you've got earnings, and that's the number everyone's really watching. And it missed by a pretty hefty 8.5%. See, this is exactly the kind of split personality report that makes investors really nervous.
And here's what happened next. The stock got hammered, dropping more than 7% as soon as the numbers came out. So that's the big question we're diving into today. Why? Why did that one miss on earnings totally blow up a really decent beat on revenue? What was it that investors saw that just made them race for the exits?
Okay, so to really get why the market reacted the way it did, you got to start with the numbers themselves. Let's take a closer look at the actual Q2 print.
So here's the breakdown. Check it out. The adjusted EPS, that's earnings per share, it came in at 65 cents when the street was looking for 71. That's the 6-cent miss that caused all the drama. But then you look down the list. Revenue, a beat by almost 17 million bucks. That's huge. And then you've got adjusted EBITDA up 8% over last year, and free cash flow, wow, up 15%. So, on paper, a lot of this actually looks really strong.
And you can bet this is the story that management was shouting from the rooftops. I mean, look at that year-over-year revenue growth. Nearly 20%, and a solid 8% growth in adjusted EBITDA. These are the numbers the execs are really focusing on, and they use them to paint this picture of, hey, we're firing on all cylinders here.
So, let's talk about that narrative. What was the actual story that the C-suite wanted everyone to hear?
Well, the CEO, Joe Hayak, really set the tone. He said, and I'm quoting here, "Our people, their talent, resilience, and creativity are enabling us to navigate the current environment very well and gain share." So the message they were sending was pretty straightforward. Look, things might be tough out there, but we are crushing it and taking market share.
And they didn't just leave it at that. They laid out this whole three-pillar strategy to back it up. So first up was organic growth. They're talking about new products and getting a bigger piece of that red-hot data center market. Then pillar two, M&A, mergers and acquisitions. They talked about getting the Elgen deal integrated and announcing another one for a company called LSI Group. And finally, number three, just optimizing the business, making everything more efficient, using their own special process. It sounds great, right? A really proactive story.
But as we already know from that stock chart, the market just wasn't buying it. So now we got to flip the coin and figure out why. Why didn't this positive story land with investors?
Yeah, that's the big one, isn't it? It brings us right back to our main question. They've got a strategy. They've got growth. So why on earth did everyone start selling?
Okay, here's the deal. Investors are smart. They looked right past that shiny revenue number and focused on some major red flags. First, that headline earnings miss. You just can't ignore that. Second, and this is a big one, gross margin pressure. Their margins were down 120 basis points, which is just a fancy way of saying 1.2%. That's a serious squeeze on profitability. Now, management pointed fingers at the Elgen acquisition for that, which leads right into the third problem. That deal is causing a near-term drag on the numbers. And to top it all off, their big construction joint venture, ClarkDietrich, showed some weakness. That's a bad sign for the commercial construction market. Put it all together, it's a recipe for a sell-off. All right, so that's the breakdown of what happened. Now for the most important part, what's going to happen next? Here's our take.
So here's our prediction. It's going to be a bit of a tug-of-war. On the one hand, their profit margins should start to look better. Why? Because all those extra costs from integrating the Elgen deal will eventually fade away. But, and this is a big but, those headwinds from the slow commercial construction market, they're not going anywhere fast. And we think that's going to put a real ceiling on how high this thing can go, at least in the short term.
And what does that mean for the stock price? Well, we expect it to be stuck in a trading range for a little while. The market's basically folding its arms and saying, prove it to me. So don't expect any big moves until investors see two specific things. First, real hard evidence that those profit margins are expanding again. And second, that this new LSI acquisition gets integrated smoothly after it closes in January. Until then, it's likely stuck in neutral.
So when you add it all up, we're putting a market perform rating on Worthington Enterprises. Look,
They're doing what they said they would strategically, but those short-term profit problems are probably going to keep the stock performing right in line with the rest of the market, not ahead of it.
And as always, just a quick reminder, this is not financial advice.